up now on the posting of those. So if there are things you want to review from previous lectures, those should be up there now, and I'll continue to try to get those up in a somewhat timely manner. Those should be posted under the appropriate chapters. Okay. This little guy, put the machine in full screen mode. And let's start to take a look at some of the things we're going to be looking at here. And we're going to spend time with projection and forecasting techniques, okay? And we're going to look at a couple of different ways of predicting costs and different outcomes under different scenarios, et cetera. That's not real heavy on the exam. I'd put maybe like 5 points on that, okay? And then, as I've told you last time, I do want you to look at the ratio analysis stuff on your own. I'm not going to go through that with you because it becomes a long discussion of here's assets, here's liabilities, divide assets by liabilities. That's your current ratio, current assets by current liabilities. I don't see any point for us to spend our time together looking at that, but you should look at that on your own. That is 5 points. And you'll see that in your task-based simulation for this chapter, you will have an opportunity to do some task-based simulation and be using these ratios. So it's not just a matter of having the ratios memorized, which you should. There's flashcards in your vector flashcards for every single one of those ratios. If there's not one, make one so that you have all those ratios in a flashcard, memorize those, but it's not just memorizing them. It's also knowing how to apply them and what they, in the context of what does it mean if you have a current ratio that's, more than one, less than one, whatever, et cetera. Okay, so take a look at that. You'll see that there's some discussion there that's very helpful. Marginal analysis, pretty straightforward stuff. I mean, I always find marginal analysis a little bit annoying because it's always comes down to choose the option that maximizes revenue, that minimizes cost, okay, or maximizes therefore profit. So it gets a little annoying that they give you all this scenario and then it's always sort of almost, okay, you get to the end and you're like, that's it. I mean, I just had to figure out which one had the most revenue or the lowest cost, okay, but we'll take a look at that. I'm thinking that's how far we'll get tonight. We will get into budgeting, part 1 and part 2, which is really, one area, but they put it in 2 different modules. And so we'll probably stop at the first, not modules, but parts. We'll stop at the first part because I think there's a better flow if we go into parts 1 and 2, and then we'll be able to wrap up next time as well with variance analysis. And variance analysis, guys, 10 points. Long been a heavy area on the exam. You absolutely have to know how to calculate these different variances. And I'm just going to show you the sort of ninja approach to getting the questions right on these next time so that we'll be covered well for the points on the variance analysis. I promise you, multiple choice questions on variance analysis, probably task-based simulation on variance analysis. Okay. All right, good. So let's go ahead then and let's take a look at our first discussion for tonight, which is forecasting techniques. Okay, we're going to look at a couple here. We're going to look at sensitivity analysis and scenario analysis. Okay, so what sensitivity analysis does is says, look, we're going to have a particular operation or project that we're going to undertake, and we want some sense as to how our profit will change if there is a different outcome or over a series of different outcomes. Okay, so sensitivity analysis is a process of experimenting with different parameters and assumptions regarding a model and cataloging the range of results to view the possible consequence of a decision. Okay, and they say here that it's also called a what if analysis. Okay, sensitivity analysis is a risk management tool. I was on a audit one time, and I had someone from Stanford that was on the team, and we had some findings regarding the way they were accounting for things. And because he wasn't an accountant and got assigned to that job, he started doing a sensitivity analysis to the findings, which they kind of threw that away. So as accountants, when I say they, our supervisors were like, yeah, no, we're not putting that in the report. Accountants aren't used to this kind of stuff, right? It's always what, here's the numbers, here's the outcome. Remember, in the BEC section of the exam, we're going to have to put on our management hat sometimes, okay? Now they tell us, and you should flashcard, okay, not only the definition, but remember, we've been pretty consistent in flashcarding pros and cons here. You should flashcard that the biggest drawback of sensitivity analysis is the implicit assumption that variables are independent. The reality is variables do not typically operate in a vacuum, and change in one will result in the change in the other. So there may not be a lot of accuracy to sensitivity analysis. Okay. All right, good. So let's just look at, and really all we need is those couple flashcards that are sort of more definitional than anything, but let's just look at this example. You know, you're not going to get a, you know, task-based simulation making you do a sensitivity analysis like this, but let's just look at this, and then it gives us a sense as to what they're talking about in those things I want you to flashcard. So July sales for Besser Company are projected to be 100,000 with cost of goods sold of 60,000 and general administrative expenses of 25. The CFO has determined that the variability in sales has the biggest impact on profitability, and she wants to determine the effect on operating income if sales dollars are over or underestimated by 25%. Okay, so that's the range of scenarios. The middle, 100%, go this way 25%, this way 25%, what will be the impact on the operating income? In order to estimate the change in operating income, the CFO assumes the cost of goods sold will consistently be 60% of sales, and general administrative expenses will stay constant at 25,000. And they ask us to go ahead and do a sensitivity analysis in which we have the assumption of 100,000 of sales, and then what happens if we are over or under our estimate by 25%. So you come over and you take a look, and we have the, you know, sort of baseline, if you will, scenario, okay? And if we're correct on that, we'll have cost of goods sold of 60%, 60,000, sales administrative expenses of 25, operating income of 5,000. If sales come to what? To 75,000, again, the cost of goods sold will be 60% of the sales, and they've told us that the general administrative expenses stay the same. If we are up 25,000, then again, 100 to 125,000, then the cost of goods sold will be 75, and they've told us selling and administrative expenses stay the same. Okay, all right. Now you come over and you take a look at scenario analysis. And with scenario analysis, we can prepare our budgets under each scenario, and the possibilities may change in order to come up with weighted totals. So you take a look, and you can flashcard that, but you take a look at this example, okay? And they say preparing the budget, we're saying that we're going to have a certain amount of sales, and we say that there's a 30% likelihood that we will have 5% growth in sales. The pessimistic scenario is that there'll be a 5% sales decline, and then the most likely is there'll be no change, and they assign probabilities to those. So what we do is we go ahead and we take each of those growth, and we assign or decline in the case of the minus 5%, and we multiply those by the probabilities. And so the probability is we're predicting 0.5 growth. And so if our sales are currently 40 million, then we're thinking for the next year we'll have 40.2 million. Okay. Now this is a very simplistic, discussion here. I mean, the big question to me would be, where did these numbers come from? The 5%, sales, and then these likelihoods on here is the big deal, but they're not going to make us do that. Okay, they'll just give us those numbers and see if we know how to put them together to come up with, a projection. Okay, now when we look at forecasting techniques, okay, and forecasting is something that is driven by historical data and actual expectations rather than hypothetical scenarios. Okay, so historical data, actual expectations. I have a loan in hand and I plan to take this loan and invest it in some sort of equipment, and I have some experience with this equipment, and so I can indicate to you what sort of revenues are going to be generated off of this equipment. A hypothetical scenario is, hey, I don't have a loan yet. I would like to get a loan, and if I had a loan, I would invest in this equipment, et cetera. So there's a hypothetical assumption in there. Well, what if I get a loan? What will I do as opposed to I have the loan and I'm going to be investing in this equipment? Okay, now for that reason, because of that hypothetical assumption, projections are typically used internally. A forecast is something that can be used both internally and externally. So basically what they say is that a forecast is okay if you're trying to produce something for the investing public to take a look at, whereas a projection would be something that you would use if you're negotiating directly with somebody for a loan or something like that, say a bank. Okay, so just go ahead and flashcard that projections are typically used internally. Forecasts are for internal and external audiences. You can just flashcard that. Okay. Okay, good. Now let's come down and look at something called regression analysis. Okay, now before you freak out and think, oh my God, I'm going to have to do a regression analysis on the CPA exam, really much of what we're going to look at is definitional and we're going to flashcard some of these things. Okay, so regression analysis explains a variation in the dependent variable as a linear function of one or more independent variables. Okay, now simple regression involves only one independent variable. Multiple regression involves more than one independent variable. So why don't you flashcard that point about the green? Now, I know that, I don't know which class it is here at GGU, but I think most of you have taken one of the data analytics classes that are in the catalog, and you probably had some exposure to the data analytics, but I'm just going to, regression analysis. But just to take a look, we have what? We have total cost, okay, on the y-axis, and we have, say, units that we're going to be producing on the x-axis. And so what happens? We probably have some fixed cost component, and we probably have a variable cost component, right? Okay, costs may behave this way, but we may be wanting to look to see, well, do our costs really behave in this manner? And so we could use regression analysis. And what regression analysis will do is it will fit a line to an set of observations, okay, that are sort of falling not quite on that line, okay, but it fits a line to those observations and gives us a reading that tells us, do these independent variables, in this case, the number of units and total cost, behave in this manner? If they do, then we can put in some observation points and come up with an equation for this and use this to predict something like our total cost or whatever it is we're looking at. Okay, so that's what regression analysis does. So when you do regression analysis, notice they give us this y equals ax plus b, where if you were to look at this, y would be total cost, the way I just kind of graphed it. A would be what? Would be fixed cost. And then b would be what? Variable cost. And of course, x would be the number of units, right? That we're using that's a UC, variable cost. And x would be the units. So again, you can use regression analysis that calls out these different factors here you know, to allow you to predict costs into the future. Now I'm sitting here as I'm looking at this, and my question is, should I have you flashcard what these things mean? Yeah, why don't you go ahead, and there may be a flashcard in the Becker cards, or you can just copy this page and make a card out of it. It's almost already at flashcard size anyway, just so that you make sure that if they show you something in an equation, you know what the elements of that equation represent. Okay, now here they kind of say what I've been saying now, which is if an application, if Y is total cost and X is the total activity or output, one goal regression analysis would be to predict cost. Y, the dependent variable based on observed total activity or output. Questions on the CPA exam expect you to predict total cost, not to do a regression analysis to be able to do that, but be able to be given what the factors are, and then they'll probably tell you, okay, if it was this at this many units, then go ahead and tell us what the cost would be if the number of units changed or something. Okay, now here's where we start to get some of the definitions, and let's start with the coefficient or correlation of the coefficient of correlation. So the coefficient of correlation measures the strength of the linear relationship between the independent variable and the dependent variable. In standard notation, the correlation is R. They call it R, and it's the range of R is from -1 to 1. Okay, so a 1 means that it is a perfectly positive correlation. As one thing moves, the other moves, and they move on a 1-for-1 basis. That's essentially the slope of that line. We go what? We go 1 this way, we go up there. We go 1, we go up this much, and that would be a positive correlation of 1. Now, as that number gets further away from 1 to 0, then that's saying to you, there is no correlation. Do not use this to try to predict costs, because there is no connection. These things are moving totally randomly, or yeah, randomly. Here, inverse correlation says, well, actually, as the independent variable increases, the dependent variable decreases. That's generally not going to be the case for a cost consideration. I mean, you're going to be somewhere in here, but you want to make sure that you have picked the correct, really you're seeing if you've selected the correct independent variable to predict whatever it is you're trying to predict, say total cost, whatever it is. Okay, so you can go ahead and flashcard this right here, and then they start to give us, I think this really says it all to you. But if you have 1, then that's perfect positive correlation. You know, ice cream sales to temperature. Gets a little hotter, people start wanting ice cream, right? So our sales of ice cream will go up when the temperature increases. Perfect or inverse correlation, you know, increase in COVID cases to restaurant revenue. Okay, when the COVID was going up and everybody had to close down, restaurant revenue was going the other way, right? As the number of cases went up, the restaurant revenue was going down. No correlation, I don't know, you know, the number of school kids to seaweed in the ocean. Okay, there's no correlation to that. Okay, so that would be 0. Okay, all right, good. Now, when we go ahead and we want to project total cost, okay? When projecting total cost, or predicting total cost, a function of fixed cost and variable costs and the volume, the independent variable, management's expectation is the correlation will be somewhere between 0 and 1. That's what I'm saying. It's not going to be negative. If it's 0, there is no correlation. So, you know, we would probably be closing our eyes and swinging if we're picking variables, and when we do the analysis, it turns out that the correlation is 0. I'm thinking it should be much closer to 1. It doesn't have to be perfect, but as it gets closer to 1, then it becomes a more reliable measure that will allow you to use that as a predictor. Okay, so more units of given product are produced, a reasonable expectation is, of course, that the total cost will increase. Now, there is another definition here, which is the coefficient of determination. So what the coefficient of determination is going to tell us is how much of that move in the independent dependent variable is really caused by the movement in the independent variable. How much of the dependent variable is really caused by the movement in the independent variable? And that's the coefficient of correlation, which determination, I should say, which essentially takes that R and squares it. Okay, so the higher the R, the greater the proportion of total variation that is explained by the variation in X. Okay, the total amount of I always get those. I always say the opposite of what I want to. How much of the change in the focus, John, in the dependent variable is caused by the change in the independent variable. Okay, so flashcard those definitions and just take a look here, and they give us some information about this cost that they're looking at. Well, I guess we can go ahead and look at this. Okay, based on 5 years of data on fixed cost and variable cost per unit, Racks and Inks determines that the fixed and variable cost next year will be 16,000 for fixed and 450 for the variable per unit. Raxon has determined the correlation of coefficient between the independent variable to be 0.9. Therefore, what we're sitting here and they want us to calculate then, well, if that's the case, what is the coefficient of determination? So we would simply take the 0.9 and we would square it, 0.90 and square that. And that's how they end up with that 0.81. And that's how you would calculate that. Okay. Now, something that they could ask us to use to predict costs is something called the HiLo method. Now, let me first let you know that the HiLo method is, not a very sophisticated way of calculating the, predictor of cost. Okay, so this probably would not be used, I don't think, for really trying to come up with a forecast that you're going to be publishing or anything like that. What you might use the HiLo method for is to come up with a predetermined overhead rate. Remember, we talked about that in a previous discussion where we said what the total estimated cost divided by the total estimated number of units gives you a predetermined overhead rate. Well, if I can use some historical data to sort of come up with an equation for that, then I can go ahead and use that to come up with my predetermined overhead rate. And it's not that big of a deal because if you're not real precise, because at the end of the accounting period, you simply would make an adjustment to close out your under or over applied overhead, and it wouldn't really have much harm because you can just correct that at the end of the accounting period, right, by closing out your over under applied overhead to your cost of goods sold. Or if it's a material difference, you would allocate that between the cost of goods sold, the work in progress, and the finished goods inventory. Okay, so let's just take a look and say that the HiLo method is a simple technique used to estimate the fixed and variable portions of cost, usually production cost. And as I said, it is probably something that's going to be used internally. It is very simple, kind of, basic way to come up with a prediction of cost. So you come over and you take a look at the example on the next page. And I kind of thought the HiLo method was actually kind of fun when I was taking the exam. I got a couple questions on it that I thought were, I felt like, I was pretty smart when I answered them. I could tell I got them right. Okay, so what happens? You have your total cost, which is Y. Your fixed cost is going to be what? Your fixed cost is basically B. Your what? Your variable cost per unit here is going to be your M, and then the number of units is X. Okay, and the reason I'm showing that to you is you probably remember from algebra or something that you know, that you took in some point in time, you know, in high school, or if you're like me, you took it in college. Y equals mx plus b is the equation for a line, right? Okay, so what happens? Well, what we're doing here is we're saying, look, we have these different observation points of how our costs have behaved at the number of units and what our total costs have been. Okay, and it could be maybe overhead costs that we're looking at here. And even though the observation points are not quite falling on this line, what we're going to do is we're going to pick the high and the low points of those observations and say, there, the line goes that way. That's how those costs behave. Now, this is not nearly as reliable as regression analysis, because regression analysis does what? It statistically fits a line to these points. All we're doing here is saying, here's the high, here's the low. This creates a line. There, that's how those costs behave. Okay, probably they aren't quite behaving that way. They may not be behaving that way at all. We're not verifying it with any kind of regression analysis, but if it's a little bit off, we'll just make an adjustment at the end of the counting period if we're using this to come up with our predetermined overhead rate. So, you know, it's not a huge deal if we don't get it exactly right. Now, what we do is we sit here and we pick the high and the low. And so we have the high month is what? 8450. The low, I guess that's the low month. The low month is February here. The high month is what? I guess May. Okay. And so we go ahead and we say, okay, well, if that's the case, okay, our what? We take our 9550 minus our 8450 minus 8450. Okay, that sits in the numerator, and then the denominator, we put the number of units. So we've got what? 1400 minus what? Minus the 1000. Right? Just label this high. This is low. Okay. So what we're doing here, and you probably remember from algebra, what did you do? You did y2 minus y1 over x2 minus x1, and that gave us the what? That gave us the slope. Okay, well, that's what we're doing here. We're sitting here and we're saying, well, since our variable cost per unit is like the slope of this line, we just calculated our variable cost per unit by sitting here and saying, okay, if that difference is 1100 and the difference on the bottom is 400, right? Then we calculate those differences. And so we were able to calculate our variable cost per unit. Once you have that variable cost per unit, then you can use that to come up with, well, what is my fixed cost? And you can use it, you can calculate it using either the high or the low, okay? You can use either. You don't have to pick one or the other, but you must use one of those two observation points. If you use the other observation points, remember, they're probably not on that line. So you can't use one of the others. You got to either use the high or the low. And so my total cost, and I'm going to go ahead and use the high, at the high is 9550, okay? And then I'm sitting there and my variable cost at those number of units is 275 times, and I'd have to put in the number of units here, which is what, 1400? Okay, 275 times 1400 gives me this 3850. So total cost minus variable cost gives me the fixed cost. Now I have what? Now I have an equation that allows me to calculate how those costs are going to move. And then I could now say, well, if I'm sitting there and I produce 10,000 units, let's just use that, then I'd say what? 5,700 plus 275 times, would I say 10,000 units? That's kind of a lot of units. That's going to be a weird number. I better not do that. Times what? Let's make it 1,800 units, okay? Times 1,800 units. That should come out to what? 5,700. I should have thought of the example beforehand, but that's all right. So we've got 2 times 2.75. How much?
4,950.
275 times 1,800
Yes.
is 4,950 plus 5,700, right?
Yes.
Okay, so that gives me now, if I'm at 1,800 units, that gives me $10,650 of
Yes.
total overhead costs, of total cost, whatever it is. And if this was overhead, then I can sit there and I can come up with my predetermined overhead rate, because I would simply do what? Say this was direct labor hours that we were using, 10,650 divided by 1,800, say direct labor hours, means that I have a overhead rate of what? Predetermined overhead rate of
$5.92.
Basically 592, right, Serena? And that then can be used to apply my overhead to my jobs as they use up direct labor. And then sometimes we say, well, what if it's wrong? Look at this. I mean, this is a mess over here. We just make an adjustment at the end of the accounting period to, close out the over or under applied overhead to, sometimes you can put it on cost of goods sold, or you may have to allocate it between cost of goods sold, work in progress, and finished goods. Question? Okay, it's not too bad. Pretty. I kind of thought that was kind of fun. Okay, now when we talk about learning curve is based on the premise that as workers become more familiar with a specific task, the amount of time that it takes them to produce, say, a unit of product should decrease. Okay. Now the analysis is used to set standards to project costs, as variable cost per unit should decline until a steady state of period is achieved. Once steady state occurs, labors per unit will remain fairly constant, I guess. I mean, nothing in life is, the only constant in life is change. In order for a learning curve analysis to be applied, activity itself must be repetitive in nature, involve intense labor, and have little to no labor force turnover or breaks in production, which of course is ridiculous because there's always labor turnover. So, okay. But I want to just look, because I think you really get the concept of learning curve better from the examples 4 and 5 on the next page. Okay, so let's just look at this. And it takes Jones Production Company 50 hours to produce the first unit and 70 hours total to produce the first 2 units. Calculate the learning curve. And to do that, you say, well, look, it's 70 hours for the first 2 units. If there were no learning curve involved, it would have taken us what? 100 hours to produce those 2 units. So we have what? We have a 70% learning curve, right? So when you're trying to calculate the learning curve, what goes in the denominator is what? What would it take us to produce a unit if there was no learning curve effect? If we just took the same amount of time on the first one versus the second one, versus in the numerator, the total amount of time that it's going to take that they've told us to produce the 2. Okay, so if you were to then take that. If it takes Jones production 50 hours to produce the first unit and 35 hours on average to produce each of the first 2 units, calculate the learning curve rate. And again, you can get that 70% that way too. Okay, so the key concept, I don't think the exam is going to have you calculating learning curves so much as they will expect you to know those definitions. Okay, good. Let's go ahead and take a look at a couple of our first multiple choice questions tonight. Hopefully my mouse is going to cooperate with me. So let's just go ahead and see what we get on these first couple ones. Okay, guys, let's go ahead and wrap up our choices here on this one. Okay. All right, and guys, don't play the game of doing something else and then, messing up my averages here for the people that got the right answer by just randomly picking something at the end. If you're going to do that, just give up. Don't come to class and don't take the exam. I don't care. Okay, but let's take a look at this 82%, which most of us got it right. And when we look at these other choices, okay, B is correct, it starts to get pretty, pretty annoying. And so some of these other things, the percentage of variation, what does the coefficient of determination mean? R squared in regression analysis. And they say the percentage of variation in the independent variable explained by the variation in the dependent variable. It's what? The independent variable is the percentage of variation in the dependent variable explained by variation in the independent variable. It's the other way around, right? Okay, so that's just pure nonsense. Percentage of variation in the dependent variable explained by the variation in the independent variables. Yeah, that's what we had said about the R squared. Measure of proximity of the actual data points to estimated data points. I don't even know what that means. Coefficient of independent variable divided by the standard error regression coefficient. I don't know what that means. Okay, there's some things I can't even explain to you. Okay. Okay, good. Let's go ahead and let's take a look at this next question. I'll give you a little more time on this one, since there's a couple of steps you got to go through. Okay, guys, let's go ahead and take a look at this one and see what we have. And looks like we got a good percentage on this. And this, I think you're seeing, is pretty straightforward. And I kind of think these are kind of fun, but let's go through this together. So the correct answer here is B, but let's look at it. And they give us these observations, and we can see that we have a high and we have a low. Now, if you run into, I don't think the CPA exam does this, but if you run into a question in which you have a series of observations, but maybe you have a high in the units, but it isn't matched by the same high in the cost, all that's telling you is, hey, this is not a perfect linear relationship. The things aren't really all lining up on that line. And so if that happens and they're asking you to use the high-low method, always look to the units. Always look to the number of units to pick whether you have a high or low. Okay, but here they matched per, the high had a high cost and the low had the lower cost. So now I can sit here and say, okay, well, if I want to get my variable cost, I can take the 160,000 minus the 132,000, and I can divide that by the 80,000 minus the 60,000, right? And when I do, just to kind of make sure we're doing our math correctly, we get what, 28,000 divided by 20,000. Okay. And when I did the math on that, I got something like $1.40. Okay, so that's our variable cost. Now that we know our variable costs, we can pick the higher the low to figure out the fixed costs. I'm going to do the low because I think probably some folks like to choose the high a lot. And so I'm just going to go ahead and do the low. So I'm going to say, well, 132,000, which is my total cost, minus my variable cost at the low number of units, as VC, variable cost. And so I'm going to have to take this $1.40 times the low number of units, which is the 60,000. Okay. And that difference, total cost minus variable cost, equals what? Equals fixed cost. And so the fixed cost here are 48,000. Okay. Now that I have that information, I can sit here and I can plug in any number of units to calculate my total cost. So my total cost would be my equation would be $1.40 times kilos, I guess, here, whatever those are, plus what? Plus the fixed cost of 48,000. And so then they give me a number that they want me to plug in here, which is the $1.40 times what? 75,000 plus the 48,000 fixed cost. And when I do the math on that, I come up with this answer, 153,000. Okay. Okay, not too bad. All right, good. Let's come over and let's take a look at starting to do some cost volume profit analysis. Yeah, it's too early for the break. We should be able to get through a lot of this, and we might go to the break a little later tonight. So I think we're okay right now. Okay, so let's take a look at cost volume profit analysis, and we're going to be looking at something called the contribution margin in determining our break-even analysis. So it is important that we understand a contribution approach to preparing our income statement. Okay, now the contribution approach is not generally accepted accounting principles, but it is better for internal analysis. Internal analysis such as break-even points, that sort of thing. Absorption is GAAP. Okay. And FASB has determined that we should use this for our external reporting of our income statement. Okay. So in the absorption approach, it is GAAP, and we do not segregate fixed and variable costs. We don't call those out separately on the income statement. Okay. Whereas when we get into our variables, the contribution approach, okay, is going to be used for our internal reporting, and we will separate out variable and fixed costs. Okay, so we also call this variables approach. Okay, so contribution is also known as variables, and we'll take a look at that here on the next slide here, next page, I should say. So the equation, it's not an equation, it's a presentation for our absorption, which we know is GAAP, is revenue less cost of goods sold, gives us gross margin, less our operating expenses, gives us, really, it's net income. Of course, we could have non-operating items. So this is really giving you the equation for operating income more than it is net income, because we're not considering tax or anything else here in this discussion. Okay, but revenue less cost of goods sold gives us the gross margin, and then we have our operating expenses. Now, when we look at revenue, that's the number of units sold times the sales price per unit.
Yeah, I get to work too, but I won't. It's not like loud work. It's just on a.
Okay, I don't have to mute now. So a little bit tempted to continue to listen there for a minute. Thought maybe we might hear something interesting, but anyway. Okay, so what happens? We have our operating income. Now, when we look at our cost of goods sold, our revenue is the number of units sold times selling price times units sold. I don't know that I even need to write that there. Less cost of goods sold, and in the cost of goods sold, we have both fixed and variable. Manufacturing costs. What are our manufacturing costs? That's a question. Manufacturing cost, people that are going to be taking the CPA exam in a couple months.
Labor.
What kind
Materials.
of labor? What kind of labor?
Direct.
Factory.
Direct labor.
Direct materials.
Factory overhead.
Yes.
And overhead, and it's both fixed and variable, right? Okay, both the fixed and the variable. And of course, direct labor, direct materials are variable, but we also, any overhead that was applied for the units sold for that period would go into our cost of goods sold, both fixed and the variable, right? Okay, good. That gives us gross margin less what? Operating expenses. In other words, what? Selling and admin. And again, it's both what? Both fixed and variable, but it's all of those that have been what? Incurred for the period. These were period costs. Okay, just hearkening back to that discussion that we had some time back. Okay, all right, good. Now, when we look at the contribution approach, and it's also called the variables approach, and sometimes it's called direct costing, okay? We don't use it for GAAP, as I said earlier, but it is better for internal decision making, okay? And it's going to allow us to calculate this contribution margin. So now the approach is revenue less variable cost. And this is what? This is all variable costs, both our manufacturing and selling and admin. So we are grouping our costs by whether they are variable or fixed. Okay, so we have both manufacturing and selling and admin. So what's in there? And it's variable cost, and it's for variable manufacturing. I should probably add to that. Well, I can just put it here for units sold for the period. Okay, so it's what for the units we've sold, it's any direct labor that's in there, any direct material that is in there, any variable manufacturing overhead. If we had sales commissions, which are selling and administrative expense, they're grouped up there. Okay, whereas for our absorption, we put that down as one of our selling and administrative expenses down in the calculation of our operating income down there. All variable costs go there. That gives us the contribution margin. Okay, now they call it contribution margin because the contribution margin will first contribute to covering any fixed cost. And then what second, after whatever's left over, the contribution margin will contribute to our net / operating income.
So are the manufacturing costs for the period, including the admin costs for the period, under the less variable costs?
Say that again.
So manufacturing and selling admin, the selling admin is for the period and it's the total manufacturing cost? Or is it only for the period?
Well, it's for the units sold.
In the period?
So whatever the number of units were we sold times the variable cost per unit for the units sold.
For the period.
You keep saying for the period, and I keep saying for the units sold.
Okay, okay.
So it's for the units sold, right? So
Correct.
if I produced 500 units, but I sold 400, then I would pick up the 400 and I would multiply the 400 by all those variable costs, direct labor, direct material, any variable overhead, and any variable selling and administrative costs, which selling and administrative costs are a period cost anyway, right?
Correct.
But I'm grouping them into whether they're variable.
Okay, all right. Thank you.
Yeah. Okay, then for our fixed cost, okay, for our fixed cost, that is going to be all fixed cost. All fixed costs, okay, all fixed costs. So manufacturing and selling and admin. And that is all fixed costs for the period. Maybe that's what you're asking. That's all fixed costs incurred for that period are automatically subtracted off in the calculation of the net income or operating income. That's all fixed costs. Okay, so when you look at this, the difference between the two is what? The difference between the two is how we're treating our fixed manufacturing cost, because our selling and admin costs are always expensed. As we sell a unit, we're going to do what? We're going to subtract off our variable manufacturing costs, our direct materials, our direct labor, our variable manufacturing overhead, and our variable selling and administrative costs. But under the contribution, under the absorption approach, we don't take those costs until we what? Until we actually sell the units, the fixed overhead. Whereas for our contribution approach for variables, we take all those costs off in the period in which they're incurred. Okay, so if you look at the next page here, and you start to look at absorption versus contribution, okay, the difference between absorption and contribution approach is the treatment of the fixed factory overhead. That's the only thing that's different, okay? Because our direct labor, direct material are variable, we are going to what? We're going to take the variable overhead cost as we sell the units under both approach. It's only when we get to the fixed overhead that we always subtract that under variables. Where under absorption, we have to wait until we actually sell those items because their fixed cost is embodied and it is sitting there and on the balance sheet until it finally goes and is part of the cost of goods sold until you actually sell that item. So you come over and you can flashcard. Well, you don't have to flashcard it here, but what I want you to do is look at the treatment of fixed overhead, just to reemphasize that point, under absorption approach. Okay, all fixed factory overhead is treated as a product cost until it is included in inventory values. Cost of goods sold includes both fixed and variable costs as those units are sold. So those fixed factory overhead costs do what? They sit on the balance sheet until you sell the item, and then they go over to what? Cost of goods sold on the income statement. Okay. Under the contribution approach, okay, period cost, all fixed factory overhead is treated as a period cost and is expensed in the period incurred. Inventory values only include what? Variable manufacturing. Okay, so that's why I kept trying to get us to, it's the units sold, in that when we subtract off our variable costs, it's for the units sold. If we don't sell the unit, the variable costs still sit on the balance sheet until what? The variable overhead costs still sit on the balance sheet until we actually sell those, whereas all fixed overhead items are immediately expensed under variables under the contribution approach. Okay, now you come over and I want you to flashcard this right here. Okay, because this does get a little bit confusing, and I understand that. But when you look at this thing, and they've kind of made this a little bit too trafficky, in my opinion, fixed manufacturing overhead is a product cost under absorption. It is what? It is a period cost under variables, direct, contribution approach, whatever different names they want to call this. If you look at the rest of this table, everything else is the same. Everything else is treated exactly the same. Okay. Okay, good. So you come over and let's just go ahead. We don't need to look at this. There's no numbers on that, so it's not very useful to us. But let's just go and look at the effect on income. Okay. And so, and I just want you to look at the passkey on this, I think is better. Okay. So what happens if we have what? No change in inventory, absorption, and variables net income will be exactly the same. Because what happened? Well, they're both putting the what? No change in inventory, so you could presume they sold everything they produced. Think about it that way. And if that's the case, then what? Then all those costs went to the income statement. There was nothing left over to hang out on the balance sheet, right? If we have what? If we have an increase in inventory, absorption has a larger net income than the variables contribution approach, because what are we doing? We're holding back that fixed manufacturing overhead on the balance sheet under absorption, whereas under variables, we're taking it immediately. And then if there's a decrease in inventory, then absorption's net income is smaller. Absorption's net income is going to be smaller because now we're taking what cost to our income statement, the cost of goods sold when we actually sell those, the fixed manufacturing overhead, whereas under variables, we would have taken that for those units in a previous period. Okay, so go ahead and flashcard that. That way that works. And then let's take a look. And again, I'm going to ask you to flashcard the pros and cons, benefits of absorption costing. It's GAAP, okay? IRS requires it, okay? So that's a benefit, flashcard that. Limitations. Okay, limitations is the net income reported under absorption model is less reliable for performance evaluations. When we say performance evaluation, we mean how well we're meeting our targets and that sort of thing, okay? When we deal with variable direct costing benefit, it can easily be used, okay? It's more reliable for performance evaluations because we can sit there and separate out our fixed cost from our variable costs, okay? The limitation is it is not GAAP, so it's sort of the mirror image here of what we said was good about absorption. The limitation of variables is that you can't use it for GAAP, you can't use it for tax purposes. Okay, all right, good. Now, with that, what I want to do is go to our class question, okay? Because if we start talking about, this example isn't very helpful. Yeah, that's not very helpful. Let's look at it. I thought maybe I could turn that into something useful, but I can't. We're gonna come back to all this, but what I want to do is go to the class question for the variables versus absorption, because I think you see that once you kind of focus in on this notion that all I have to do is understand the difference between the two is how I treat the fixed manufacturing overhead, you'll be able to answer a question like question 3 here pretty easily. Okay, so let's go ahead and I'm just going to let you do that. I'll give you a couple of minutes on that. Okay, guys, I'm gonna go ahead and end the poll here because I think that it would be sort of a problem if you were spending a lot of time with this question, because it means you're probably off base. So let's just go ahead and look at this. But good, most of us got it right. 82% of us, so that's a pretty good percentage. We're doing good today on our percentages. I'm glad to see that. So let's just go ahead and let's take a look at this question. And this was kind of a generous question, because they tell us the use of absorption rather than variables would result in higher net income of what amount? I mean, this question could have given you what amounts that maybe would be lower or higher. And then you'd have to remember our rules about what, if the inventory is increasing, absorption will have a higher. If the inventory levels are decreasing, variables would have a higher, or if they're the same, there's no difference. You didn't have to remember that here because they told you absorption is going to have a bigger. And the reason it is that what? It was their first year of operations and they ended up with what? 2,000 units in inventory on hand. In other words, they started with zero inventory as you start a year, right? And when you start your business, and then you end up with 2,000 units, your inventory increased. Now they give us the variable cost here, but the difference between the two is the treatment of what? The fixed manufacturing overhead per unit, right? So that's all we have to pick up. We pick up that $30 here. The variable costs don't matter. They're going to be expensed as those units are sold. It's the fixed manufacturing overhead cost that under variables would have already been costed out, right? Okay, you reduced our net income, whereas under absorption, we're still carrying those costs on the balance sheet in the form of inventory, these 2,000 units of inventory. So we take the $30 times the 2,000 units gives us the 60,000. Question? That's why the two key things, guys, there is the increase and decrease in inventory and the effect on operating income under the two methods. And remembering that the difference between the two is the treatment of the fixed manufacturing overhead. You keep those two concepts in mind, get that solid. You get used to practicing with those two concepts. These questions that could be tough actually end up being pretty easy. Okay. All right, good. So that means that we should take the break now. I think that's actually a good breaking point for us. And when we come back, we'll start to talk about break-even analysis and some other types of analysis that we'll be able to do now that we understand that we can have this contribution approach to our income statement. We can start to use it to make some of these decisions or do some of these analysis like break-even analysis and stuff. Okay, so let's come back 6:30. We'll take 10 minutes and come back at 6:30. I'm going to pause the recording. Somebody remind me to start it up again. Okay, and let's start to look at the notion of break-even analysis. Okay, so when we look at break-even analysis, we'll be taking a look at our contribution margin. And we'll be seeing to what extent we can generate enough contribution margin to first cover fixed cost. And at that point, we will break even. And then anything that's left over contribution margin after we have covered our fixed cost will go to profit. Okay, now we'll talk about target profit after we talk about break even, but to break even, we have to at least cover our fixed costs. Now, what we're going to do to calculate the contribution margin, we're going to look at this examples, the best way for us to study this. But I think I really don't even expect you to flashcard this at all. Our contribution margin is our sales price, and we often look at it contribution margin per unit. Okay, so it's our sales price per unit minus our variable cost. per unit. Okay, that gives us our contribution margin per unit. Okay, now sometimes they'll give us the entire sales, and we'll have to know then that we're going to have to take the entire amount of sales and divide it by the number of units to get the sales price per unit. They'll give us the total variable cost. We'll have to divide that by the number of units to get our variable cost per unit. And that will give us the contribution margin per unit. Or if they just give you the sales and the variable cost in total, then you can just subtract those and then just divide the contribution margin in total by the number of units. So there's a different ways that you'll have to apply this concept. Sometimes they'll give it to us by unit, sometimes they won't, and we'll have to calculate the per unit amounts. Okay. Now, when we look at this, we have this particular product that has a sales price of $125 and variable cost of $50. So very, basic, straightforward calculation here, just like we did here. You would go ahead and take the Take the sales price per unit minus the variable cost per unit, gives me contribution margin per unit of $50. Okay. Now they tell us that the contribution margin ratio here is 60%. They didn't have to tell us that. We could have calculated that by simply taking the sales price, divide that into the contribution margin, gives me the contribution margin ratio. Okay, and then they tell us that our fixed costs are 150,000, and we have a desired pre-tax profit, okay, of 60,000, a tax rate of 40, and desired after-tax profit of 36,000. Okay, 60 times 60% would have given us the 36,000. And then they give us the potential unit sales of 2,500 and a maximum of 300 sales to reach market saturation. Okay, so they give us all of these different things here, and we're going to go through and do a variety of calculations, starting with break even in units. So we come over to the next page, and they give us the break even in units here, and you can flashcard this, but it's our total fixed cost divided by the contribution margin per unit will give us the break even point in units. Okay, but when I do these calculations, just to make sure I haven't missed something, I always set it up a little longer than that. I say, look, I want to know the break even in units. I know that break even in units, break even units is what I'm trying to come up with. And I know that that will be equal to what? The contribution margin per unit times the times the break even in units is actually over here. Sorry, guys. And I know that that has to equal what? Has to equal my fixed costs. Okay, so I set it up this way. Yeah, I have a contribution margin per unit. My contribution margin first goes to cover my fixed costs. So if I want to break even, I have to generate enough sales, right, in units to cover those fixed costs. And then I simply do the algebra, divide each side by the contribution margin per unit, and that gives me the formula that you can go ahead and flashcard. Okay, now let's just look at this particular, and it's pretty straightforward. They had the contribution margin of 75. They have the fixed cost of 150, so they have to sell 2,000 units to break even, to just cover those 150,000 of those 150,000 of fixed cost. Question? Okay, now if you want to turn that into dollars, okay, very, very simple. Just simply take the unit sales price times what you just calculated as a break even in units. And, this is a little silly here, and that, you know, they go ahead and they just give you the example here, which is the 125 times the 2,000 units. Okay. Okay, good. Now you come over and they talk about use of the contribution margin ratio. And the contribution margin ratio, what it does is it automatically turns the answer into dollars. So we don't have to do that second calculation by doing the units times the sales price. So now all you have to do is you take the total fixed cost and you divide that by the contribution margin ratio. Remember, contribution margin ratio is the contribution margin divided by the sales price, right? So they tell us here, well, they told us on the previous page, right, that let's just put those numbers in. What was it? 125 was the sales price and the contribution margin ratio was 75. Am I remembering that correctly, guys? Guys, am I remembering that
Yes.
correctly?
Yes.
Yeah. Okay. So that gave us that 60%, right? Okay. So that's where that number's coming from. It should have just gone ahead and showed you how to calculate it here again, but that's fine. Okay. And so when you do it that way, you're saying what? Contribution margin ratio, right? Times the what? Break even sales dollars, which is the unknown here. There's only 2 lines through a dollar sign, John. Okay, which is sort of what we're trying to calculate here, right? Has to equal the fixed cost. Okay, and then you just go ahead and you do that math and you come up with the same answer that we got when we multiplied the $125 times the whatever the break even in units was, 2,000 units, whatever it was. Okay, question? Okay, good. Now, if you want a profit, and I think most business people would say they want a profit, then all you do is you add the profit to the numerator here, because we first cover our fixed costs, but if we want more than that, then of course we're going to have to generate more units. So we're making that numerator bigger. So and we'll keep the same denominator. So the number of units, of course, are going to come up to 2,800 units. Now, I don't know why they went through all this nonsense over here to turn that into a dollar amount. I don't know what all this means here. I mean, I just kept staring at that and I'm like, I couldn't justify asking you to flashcard that when all we have to do is take the 2,800 units that are needed to meet our target profit and multiply it by the frickin' sales price of 125, and you get the answer. You get what? 350. I mean, why are they making us go through all that other nonsense there? Okay. Okay, good. Or you could use what? Contribution margin ratio, and that automatically turns it into dollars. Okay, so I guess you could flashcard that. Okay, all right, good. Now you come over and we want to see what we should do to come. Oh, well, they're just using the example now. Okay, they're just putting numbers from the example now, where they put in a target profit in the numerator and they use a contribution margin ratio and they came up with 350, which we also proved up here by multiplying the break target profit units times the sales price. Okay, question? Okay, good. Now, predicting profits based on volume, and look, all they're doing here is saying, well, look, calculate Green's profit if the company sells 2,500 units. Well, what happens if 2,000 units were break even? Then you would take those additional 500 units times the $75, and that would give you the 37,500. So, you know, if you had a break even of 2,000, and then the question says, well, what if they sell 2,500? what will be the profit? Well, you just take the amount over the break-even units, multiply that by the contribution margin, and that's going to go towards profit because at 2,000 units, we would have already covered our fixed cost. Okay. All right, good. Let's come over and let's take a look at margin of safety. Okay. And margin of safety concepts are basically saying, hey, we want to have an amount over our break even, and that amount that we sell over our break even is going to be called a margin of safety. Okay, so you can just go ahead and flashcard that. Total sales minus my break even sales, that difference would be called a margin of safety. That's how far we are over our break even point. Okay. If you want the margin of safety percentage, margin of safety now divided by our total sales will give you that as a percentage. Margin of safety in dollars divided by total sales. Okay. And look, guys, I'm not going to sit here and, insult your intelligence. This is the profit area, right? Where sales are more than my total cost. This is loss area down here. And this is going to be what? Break even. I think you know how to read that. Okay. Okay, good. Target costing. Okay, and target costing is you're basically going to come up with what you're going to charge for your product based on the profit you want. So what is your market price minus the required profit? That's going to be your target cost. Okay, if I'm saying, well, I could sell it for this, I want profit of that, then it means I'm going to have to keep my cost at this level. Now, if you do that, there are implications to target costing that we should take a look at. And so let's flashcard some of these, because again, that starts to get into the pros and cons of these different ideas. So let's flashcard that. Compromise quality, right? Hey, we got to have this profit. We got to keep this cost here. So let's cut back on the materials or something, along those lines, right? Increased marketing and downstream costs. Firms competing in this type of environment may incur increased downstream costs and attempt to differentiate their product, create brand loyalty. Increased complexity in cost measurement. Okay, I don't know that that's a bad thing necessarily, but it means you're going to have to implement something like what activity-based costing or something to make sure you're properly allocating your costs. Remember the bottles and the cans example that we had when we talked about ABC. And then product redesign to provide reduction of cost through the life cycle. I guess that's called the Bayesian method. Okay, flashcard those implications. I don't know that they're pros and cons, but I still want you to flashcard. Okay, good. So let's take a look now at some of these questions. Okay, guys, let's go ahead and take our best shot on this one now. And we did pretty good on this one. 93% of us got it correct. Okay, so that's good. And the break-even analysis assumes, and over the relevant range, I don't know that I defined that phrase for you. Over the relevant range means that I'm not going to have to add another factory building or something. So I'm probably under capacity. Relevant range meaning that I'm not going to have to make a major change, in which case I'll probably start incurring more fixed costs. Okay, but the total cost, total variable costs are unchanged per unit. Variable costs. Obviously, the variable costs are going to go up as production increases, but the per unit variable cost stays the same, right? Okay. All right, good. Let's go ahead and let's take a look at this question number 2 here. Okay, guys, so I've given you 3 minutes. I'll give you 10 more seconds. Okay, so that's a little longer than it probably should have taken with this question, but I could see a question like this definitely taking in the 2 minute to maybe 3 minute range on the exam. And so again, good good turnout here. 88% of us got it correct, but let's just go through this one together because I think it highlights a couple of interesting points for us. So they want us to sit here and calculate the total contribution margin for the month here. Okay, now, as you know, contribution margin is sales price minus variable cost. And in our contribution format, our variable costing approach, right? We're going to take all of our variable costs, whatever they are, and subtract them from the sales price. So we'd have what? We'd have the $80. And when you're taking the exam, I recommend that you write these numbers down. I know it's tempting to just go to the calculator and start pumping in numbers, but then you make a mistake in how you pump the numbers in, and then you've got to go back and figure out everything again. So you're better off writing down the numbers as you go, okay, the way I'm doing. So we have what? We have our selling price, and then we start taking off the variable cost, the direct materials, right? I have to subtract that, the direct labor, yeah, those are variable. The variable manufacturing overhead, that's $3, good. The variable selling and administrative, yeah, we group all of our variable costs together. They start giving me the fixed cost down here, but I'm not interested in that in order to calculate the contribution margin, right? So I come up with a unit contribution margin. If I subtract all that out of $40 per unit, right? Is that what everybody got? Okay. And then this, and I think this was, I forget who was asking me now about, is it for the period? And I kept saying, no, it's for the units sold. Who asked me that? Who asked me that question?
I did.
Oh, okay, thanks, Jason. Jason, you had asked me that, and I kept saying, no, it's the number of units what? Sold, right? So that was a good question.
Correct.
Because, yeah, because you have to know which of those to pick up here to get this correct. So you'd have to sit here and multiply that by the 4,500 units sold, because it's as we sell the units, right, that we put them into the variable cost and calculate our contribution margin. So that gives me $40 times the 4,500. That gives me 180,000 if I'm doing my math correctly, and that gives me answer B, which most of us got. Okay, good. Now let me play jazz with this question. Okay. What if the question asked me, well, let me ask you two questions that this question could ask. Is absorption or variables going to have the higher operating income? Serena, if you're talking, you want to unmute.
I'm guessing absorption.
Absorption, you're guessing because?
Yes, I think because there's an ending inventory where some fixed costs are sitting.
Right, the ending inventory increased, didn't it? 500, because we started with 0, we produced 5,000, and we only sold 4,500. So the ending inventory went up 500. So absorption will have the higher net income. Do you know how to calculate the amount that it'll be higher? What if this question asks you, how much higher will the absorption net income be? We saw another question like that, but I'm turning this into that kind of question. And on the exam, they might very well sit there and give you this, ask you to do this, and then say, taking the same information for question 2, how much higher, lower would the absorption be versus the variables? We know it's going to be higher. How would you calculate that? Could you calculate that?
Would you apply the variable costs for the entire month's production instead of just the 4,500 sold?
No, well, no.
Is the fixed cost per unit times the inventory,
Good. Which fixed cost?
the 76 and 58?
Okay, the manufacturing overhead fixed cost is. the one
Oh, yeah,
that's-
yeah, just that.
Yeah, just that. Good. So because selling and administrative, you're going to be expensive either way. The difference between the two is how we treat the fixed manufacturing overhead. Good. So we take this, what? We take this 76,000, we divide it by what? We divide it to get the cost per unit. We divide it by what? By
5,000.
by the number of units that were actually produced, right? And that will give us an amount per unit. Anybody got a number for me there? 76,000 divided by 5,000?
15.2.
$15.20 per unit.
Yes.
Okay. And then we would multiply that by what?
500.
500 units. That's how much more the absorptions net income, operating income would be over variables.
7,600 is the total.
7,600. Okay, thank you. Okay, that question didn't ask that, obviously, but you may see something in your homework or something that does that. I hope they put a question like that in there, because if I was teaching cost accounting, I would absolutely give you a question like that, you know, on an exam. Okay, all right, good. So let's go ahead. We've seen question 3, which was very similar to what I just showed you up there. Let's go ahead and let's do this number 4. Okay, guys, you've had 3 minutes. I'll give you 10 more seconds. Okay, I'm going to go ahead and end the poll. So let's go ahead and take a look at this one. And good. Most of us got it right. We're doing well tonight. We're getting these pretty much correct on a consistent basis. Okay, so that's good. That parlays into success on the homework, then parlays into success on the exam, right? Okay, so you're going down the right path here. Keep up the good work. Okay, but let's just go ahead and let's take a look at this question. And they want the break-even point in units. Okay, so there's a couple of things you're going to have to do to calculate break-even. I know I need the contribution margin per unit, and I know I need the fixed cost, right? And so you look at this thing and you're like, well, how the heck am I supposed to come up with the fixed cost when they only give me what? A per unit amount for my fixed cost, but they don't give me the number of units. Well, the trick there would have been to do what? Take the 900,000, divide it by what? The sales price per unit of $20. That means that I'm selling what? 45,000 units. Now that I know that I have 45,000 units, right, then I can take the fixed cost per unit, both the variable and selling and administrative, times $10, gives me fixed cost total of 450,000. Now that I have that, now all I have to do is sit here and figure out what is the contribution margin per unit, and the contribution margin per unit is the $20 minus what? Prime costs are direct materials, direct labor. Okay, so unfortunately, you got to remember that definition. And then our variable manufacturing overhead is $1, and our variable selling administrative is $1. So our sales price minus our variable cost leaves us a contribution margin of $12 per unit. That's my contribution margin, okay, per unit. Now that I know my contribution margin per unit, I'm home free here. I simply take the 450,000, divide it by the $12 contribution margin per unit, and I now have to produce 37,500 units to break even. Okay. Okay, good. Module 3, I'm going to ask you to do on your own. Okay, again, it is ratio analysis. There are several ratios that you're going to have to make sure you have memorized. And also you need to understand the implications of what these different ratios mean. But I don't see a whole lot of advantage in us kind of going through and just plugging numbers into formula and then, you know, coming up with these ratio. You can do that on your own. Okay. All right, good. Let's go ahead then and turn to our next module, which is module 4, marginal analysis. Module 4, marginal analysis. Okay. So go ahead and turn to, what is it, page 39? Okay. Okay, good. And let's go ahead and take a look at this idea of relevant cost. Okay, and let's just come down and take a look at incremental cost. Okay, and they tell us that incremental cost, the cost associated with a particular decision, how my cost goes up as I make a particular decision, are relevant and include all variable cost and any avoidable fixed costs associated with a decision. So incremental costs are the variable costs, and all fixed costs associated that are avoidable associated with the decision. Okay, those are all considered incremental and relevant. Okay, now opportunity cost is not an incremental cost, but it is relevant. to a decision. Okay, an opportunity cost is the next best alternative when making a decision. Opportunity, once you make one decision, then the opportunity that you lose by decision, you lose the opportunity from decision B by making decision A. That is relevant. Okay, so flashcard, these definitions in flashcard that both incremental and opportunity cost are relevant costs when making a decision. Now you come over and they give us some examples of opportunity cost. The one that I, will look at here with you is costs associated with alternative use of plant space are relevant. So I'm going to, we'll see in a minute, I'm going to be potentially using some of my plant capacity for another product. Well, I'm going to lose the contribution margin of that new product that I'm taking on, and I would have to calculate that as an opportunity cost. Now, the one that I like to use, though, that I think you can immediately relate to is you are incurring opportunity costs right now. You could be what? You could be, instead of pursuing education, maybe working and making, money somewhere, but you're saying, hey, look, I'm going to incur that opportunity cost because I think I've got, better outcome down the road, right? Now, when you look at a sunk costs are unavoidable because they were incurred in the past and cannot be recovered. Okay, so what happens? Let's say a movie star, a director of films, comes to you and says, you're the person I'm looking for to be my next action hero, right? And I'm going to pay you $5 million per film, whatever, 10 million, $50 million per film, whatever, right? And so you sit there and you say, wow, okay, yeah, I want to do that, right? Well, you would go ahead and do that, and you'd say, I'm going to go ahead and accept that. And part of the decision is not going to be, well, let's see, I really shouldn't take that opportunity because I've already spent too much money on my tuition and I don't want to waste that money now that I've spent on my tuition. That would be irrelevant. That's a sunk cost, and that would not be relevant to your decision. Okay. Now, what could be relevant is you'd say, but all I really wanted to do is be a CPA. No, thank you. Well, okay, if that's the case and you decide that, that's fine. That would be relevant. Okay. But the amount that you've already spent on tuition would not be a relevant cost. Okay. All right, good. It would be a sunk cost and would not be relevant to the decision. Okay. All right, good. Flashcard that, and then let's come over and let's take a look at capacity issues. Okay. And so what happens? Special orders. Somebody comes to you and they say, hey, I want you to produce an extra 3,000 bikes or something. Special orders are short-term decisions that often assume excess capacity. Fixed costs are generally not relevant to these decisions unless the special order will change the total fixed cost. In other words, I'm going to have to add, a new machine, or I'm going to have to add space to my factory or open up another factory or something. Okay. Now they tell us that the special order should be accepted if the selling price per unit is greater than the variable cost per unit. Okay, so that's telling you what? Hey, I'm going to increase my contribution margin by taking on this special order. And if I have enough capacity to take it on, fine. Now, if you have presumed full capacity, actually, let's look at the example first of presumed excess capacity before we try to clog our minds with this other concept. Then I'll come back to the presumed full capacity. Okay, but let's just go ahead, and they give us some information, and they tell us that the thing is normally sold for $150 per unit, and we have this set of costs associated with this, and there's this one-time order of 1,000, and they want to know what the minimum price would have to be, or what more it would have to be in order to generate a profitable endeavor for us here. So you would take the $20 and you'd subtract all variable costs, 15 for the, oh, I'm sorry, you take the 150. I picked up the wrong number there. It's at the top. You take the 150 because I want contribution margin, sales price, and then I start subtracting the variable cost. That's how I'm going to come up with the contribution margin, right? So I start to subtract the 20 for the direct materials, the 15 for the direct labor, the 12 for the variable manufacturing overhead. I don't pick up the fixed cost because I'm trying to get contribution margin here. So I pick up what? And shipping is a what? Is a variable selling expense, right? When you pay the freight, okay? When you pay the freight, that's a selling expense, and that you don't have to incur that cost if you don't sell the thing and ship it. So I go ahead and I do the math on that. I subtract all these variable costs, and that gives me $50 is the contribution margin per unit. So I have to at least sell this for what? For $50 is the answer to this question. Now, what if you wanted to make, say, $3,000 profit on this whole deal? What would you do? How would you set up your sales price? You want to make $3,000 profit on this whole deal. Because all this is telling me is you'll break even if you price it at 50. But, you know, you're not going to do this just for fun. You know, you're trying to make a profit on this. Let's say you want to make $3,000 profit on this whole deal. How would that affect the price?
Would you add the 3,000 to the fixed cost and do the calculation again?
No, we didn't really use the fixed cost here. Well, if I want $3,000 profit,
You'd work backward.
what does that mean? I'd work backward. I'm not sure what that means. You want $3,000 profit by selling these 1,000 units. I'm breaking even at $50 per unit.
So is that you use $3,000 divided by 50 units? So you add 1, 2, 3 divided by 50. You add 60 units to 150 units. So you need to have 210 units. Oh,
No, I got a deal here to sell 1,000 units.
Oh,
The analysis here told me that I have to at least charge $50 per unit just to break even. And I'm telling you, nobody does that unless they're bored. You know, they want to just make these units.
So I have to sell it at 53.
Okay, good. How did you do that?
Just the 3,000 that you are the profit divided by the units ordered 1,000. You give me
Divided by
$3.
1,000 units means I need an extra $3 per unit, don't I?
Yes, and add it to the fixed the variable cost.
Good. I add it to the variable cost. So I have to at least sell this for 53 bucks, don't I?
Yes.
To get about 3,000 profit. Good. Excellent. Okay. Very good. Somebody's on fire today. All right. So now I sit here and I say, well, what if I have full capacity? So now I'm going to come back. And now I have to, because opportunity cost is relevant, I have to do what? If the company is operating at full capacity, the opportunity cost of producing a special order should be included in the analysis. And the opportunity cost would be any contribution margin that will be lost because we're going to have to stop by whatever it is we stop producing to create the capacity to take on this new deal. Okay, so go ahead and flashcard if the company is operating at full capacity, opportunity cost of producing a special order should be included in the analysis. And the opportunity cost is the contribution margin that would have been produced if the special order was not accepted. So now you come over and we take a look and they kind of give us the same scenario here, but now they say assume that they are operating at full capacity, and the next best alternative capacity is production of another unit which has a contribution margin of 10,000. So that means that I'm now doing what? that means that I'm giving up 10,000. And if it's a contribution margin, if it's 1,000 units, then I have to get an extra what? $10 per unit to cover that lost contribution margin. So I'd have to sell it for 60. And again, I think they kind of fall off the page here a little bit on the analysis by not saying, and then you'd still want to put a profit on top of that, say the 3,000. So it'd have to be $63, because why would you do that? Unless you're trying to somehow build up some new customer or something like that. But there would be no reason to accept this at $60 when you already had the 10,000 contribution. The 50 is only covering your, your fixed cost on this. And so, you'd start to sit there and want to, probably go up above the $60. Okay. All right. Good. Strategic factors. Okay. And let's go ahead and flashcard this. You start giving special order prices, and now everybody wants special order prices. Okay. That could be a problem. The benefit would be possibly getting a new customer. The pricing of the special order, the impact of income taxes, and the effect on machinery maintenance programs. So just flashcard that. Okay, good. Make versus buy decision. Okay, should I make something internally or should I buy it externally? And we, of course, are going to select the lowest cost alternative. And make or buy decision is also referred to as outsourcing. There we go. Okay, so flashcard that. Okay, and then again, we have to consider whether we have excess capacity or no excess capacity. If there is excess capacity, the cost of making the product internally is the cost that will be avoided if the product is not made and therefore acquired outside, and that will be the maximum outside purchase price. Don't purchase it outside if you can make it cheaper, right? And if no excess capacity, the cost of making the product internally is the cost that will be avoided if the product is not made, plus the opportunity cost associated with the decision. So now you'd have to include in there any contribution margin that would be lost, because now you're sitting here and you're not making something that was potentially giving you a contribution margin before. Okay, so let's just go and look at this next one. And we have this offset manufacturing produces 20,000 units, and they give us the production cost. An outside manufacturer approaches and offers to sell the same part for $5 per unit. Okay, let me go ahead and highlight that. Okay, for $5 per unit, offset has excess capacity, and the $10,000 factory supervisor is the only fixed cost that will be eliminated if offset purchases the part. And I'm thinking if we're paying this person $10,000 a year, they should go find another job anyway. So anyway, 10,000, that's their whole salary. So anyway, we look at this, and if we buy these things, outside, they're going to charge us $5 per unit, and it's going to be what, 20,000 units. 5 times 20,000 gives us 100,000, right? Okay, now that we know is the $5 per unit. Okay, so we got that. Okay, now we look and we say, well, what happens if we make the thing, but this materials and labor will be there. The factory overhead will be there. The only thing that's going to change is that we'll have this 10,000 avoidable factory overhead that we will no longer be incurring. So the real cost of making this thing internally is 80,000. The remaining 30,000 going to be there anyway. So it's not relevant to the decision. It's not an avoidable cost. So we go ahead and we say, well, it cost us 80 versus 100,000. In other words, it's going to cost us what? only $4 per unit. So we have a difference of what, 20,000 or $1 per unit in favor of continuing to make this internally. Okay. Again, strategic factors, we should flashcard these. Okay, the quality of the product, if we purchase it outside, we'll lose some quality control. Reliability of the purchased product, the value of the service contracts or other warranties that we may be giving with items that we now are worried about. You know, we have to trust these manufacturers outside to do a good job with these. Risk associated with outsourcing. What happens if they all of a sudden tell us, hey, we can't meet your capacity anymore, right? And the most efficient use of the entity's resources. Okay, so really these come down largely to quality control issues. Okay, but go ahead and flashcard those. Okay, now you come over and the next page, we talk about sell or process further. Okay, and so what happens? We talked about joint costs, and joint costs are sunk costs that are not relevant to the decision as to whether to sell or to process further. So let's say we're making gasoline, and we have gasoline, we have oil, right? And at some point, however we're doing this, there is no difference between the oil and the gasoline, right? Okay. Then we have separable costs, and as you know from our discussion of joint costs, but you can flashcard that it's not relevant. So whatever we had to produce, whatever cost we incurred to produce the oil, okay, that's a sunk cost. Separable costs are costs that are incurred after the split off. So after you start to go into different types of oil, I don't know, different grades of oil and whatnot, versus the gasoline, then you start to have separable costs. And those are relevant to this decision as to whether to sell it now as it is this, you know, basic oil, or sell it as, you know, continue to process it and sell it as gasoline. Okay, and so look, if somebody on this call is in the oil and gas business, please forgive me, because I'm sure I'm not mentioning this correctly. Okay, I'm saying this correctly, but the concept is correct. But the, you know, the manufacturing, I know nothing about manufacturing oil and gasoline. Okay, so the decision on whether to sell at the split off point is made by comparing the incremental cost and the incremental revenue generated after split off. And flashcard, if the incremental revenue exceeds, if the incremental revenue exceeds the incremental cost, the organization should process further. We're going to make more revenue if we keep going and turn it into gasoline versus selling it as oil. If the incremental cost exceeds the incremental revenue, we should sell before we split off. Okay, I don't think we need that example. I think we've got enough there. Okay, all right, good. Keep or drop a segment. Okay, and let's take a look at decision factors. Okay, and a firm should compare the fixed cost that can be avoided if the segment is dropped, okay, to the contribution margin that will be lost if the segment is dropped. Keep the segment if lost contribution margin exceeds the avoidable cost. Drop the segment if the lost contribution margin is less than the avoidable fixed cost. Flashcard that rule, if you want to call it that. And then let's just look at this, I guess it's some sort of, you know, soup chowder head factories, and they have these different types of chowder over here, and we see the contribution margin that's coming from each one of those, and then they take the fixed costs and they sort of allocate it evenly between the three units, making Conch look like a loser, right? But they tell us that we're not going to lose any of the fixed cost if we get rid of Conch. Nothing will go away. We're still going to have that same total 60,000 of fixed cost. And so we clearly should not get rid of conch because we'll take away that 15,000 contribution margin. So instead of us being a profitable company overall, we're zero because we didn't reduce any of our fixed costs, right? Our fixed costs are still 60,000. And we got rid of something that was contributing to the fixed cost, that $15,000, right? Hello? Question? No? Okay, makes sense. Okay, now, when you look at this next, example, or using the same fact pattern, but now they say, assume that 16,000 of fixed costs are avoidable. I don't need to read anything else. If the contribution margin is only 15,000 and I can avoid 16,000 of costs, then the company is going to have increased profitability, aren't they? $1,000 because they got rid of 16,000 of fixed costs and they sacrificed what a contribution margin of 15,000 from this conch, whatever that is. Question? Okay, good. Strategic factors, okay, and take a look. The complementary, nature of products, gee, if I've had the corn, now I got to try the conch, right? I've had the conch, now I got to try the corn, right? So maybe you'll have something like that. The impact on employee morale, this guy who was making whatever, he was making, then we got rid of his job. Now all the employees are upset. The growth potential of each product, regardless of individual profitability and opportunity costs associated with the available capacity. In other words, maybe we get rid of conch, we could start producing some other product that might have, even higher contribution margins. So you'd have to consider that too. Okay. All right, good. Let's take a look at a couple questions.
You put the poll up.
Oh yeah, sorry. Okay, guys, let's go ahead and take a look at this one. I'm going to end the poll, and pretty straightforward here. Looks like everybody got it right. So let's just quickly look at that one. And what happened? We have a 12,000 unit capacity factory, and we currently produce 10,000 units. And so we've got an opportunity to sell these additional 1,000 units, and we're not going to upset any of our operations, right? Incur any additional fixed cost at all. And so what happens? We would just take the variable costs, which are 50,000, divide that by what? By the 1,000 circuits. And that means we have to sit here and what? We have to, or not the 1,000 circuits, excuse me.
The 10,000, right?
10,000 circuits, yeah. Because the variable cost is what? $5 per unit here. Okay, so we have to at least charge what? At least charge $5, and of course we would charge more than that, because again, why would we do this unless we thought we would make some money? So it would exceed that $5. Okay. Yeah, I'll let you do this next. I was going to say we'll do it together, but let's let you look at it. Okay, guys, that's about 2 minutes. So let's go ahead and take a look at this one. And this doesn't want to let me move the poll to where I can end it. Okay, so let me end that and share the results. And everybody got this right. Okay, so I can stop sharing, and I think I can close the poll without closing the whole thing. Okay, good. And let's just take a look. And now it's a 10,000 capacity factory, and we're producing 10,000 circuits. So we do not have excess capacity. So now we have to consider the opportunity costs associated with getting rid of this other opportunity. We're presumably already producing 1,000 units with contribution margin of 2,000. So we have to add that opportunity cost onto our previous answer. So we know we have to cover the variable costs, which is the same set of information, was $5. And now I need to cover this contribution margin loss, this opportunity loss, which is $2,000 divided by the 1,000 units, right? And that gives me $2 per unit. So I'd have to exceed, and again, they say exceed because nobody's going to sit here and do this for fun. We'd have to exceed $7. Okay. All right, guys, that's going to be it for tonight. I think that's enough information for you to get through the first 4 modules. Don't forget, I want you to look at the ratio analysis module on your own. So I think that's going to keep you pretty busy for this next week. And then we'll pick up budgeting part 1, part 2. That way we kind of deal with it all in one thought process. And then the very important area of variance analysis we'll get to next time for chapter 4. Okay. Okay, Yunki, I think you had wanted to stay. And so if there's no other questions at this time, we will go ahead and adjourn class.
Thank
Thank
you.
you.